Hello, thank you all so much for joining our money mapping webinar. My name is Katie Griffin, and I am on the community education team at Int Credit Union. I've been with Int Credit Union about 6.5 years at this point, and but I've been working in the industry for the last 15 years. And a lot of that time was spent working in the branches, which was a really great experience. Learned a lot of ways to help our members out and just learned a whole lot of stuff. And so now I'm on the education team and get to go out in the community and do these types of financial wellness classes, which I just love so much. And I appreciate you for joining us today. So in today's webinar, a few points that we're going to hit on today. First is we're going to talk about some budgeting methods, so different strategies that you can use to get your budgeting plan in place. We're going to cover those budget busters, so things to be mindful of so that we don't get thrown off track. And then we will also get into some different types of saving. Now, when it comes to our budget, everyone's budget is going to look a little bit different, right? We all have different things going on. But I think ultimately we all are looking for that financial security to know that things are going to be okay. We can have things paid for, have some for savings, some for fun stuff, and just know that things are going to be okay. So, the first step in our budgeting plan is just to acknowledge, where are you now? Are you someone that has never made a budget before? Maybe we're just swiping that debit card and just making sure that, or hoping rather, that there's enough in our checking account to cover that purchase. Or maybe we have made a budget before, or maybe it was a couple years ago and things change, right? Life happens, and maybe it's a appropriate time to reevaluate and see if we need to make some edits to our budget. But also think about where you're going. What are those goals, those things that you want to work towards? So maybe you have a goal of paying off some debt, or perhaps you want to save up for a house or save up for a car, go on a really cool vacation. Some of us, our goal is just to simply not have that stress that can so often be associated with money and our finances. So whatever your goal is, that is going to be unique to you, right? We all have different goals, have different things that we are striving for. So keep those goals in mind as you are creating your budget. And then lastly, how do you want to spend your money and why? So our budget is going to be a direct reflection of our priorities and our values, those things that are really important to us. So how do we want to spend our money? Are we spending it in a way that's supporting those things that are important to us, or are we spending in a way that's taking away from those things? So some different things to keep in mind, particularly with those goals. Think about, what are the things that you want to achieve, that you are working towards, that you want to save up for, and keep those in mind as you're creating your budget. Now, there's a lot of different budgeting strategies out there, but we want to share a couple in particular. So the first is the envelope method. The original way to do the envelope method was to have actual physical envelopes and write on them that spending category. So we might have an envelope for rent, an envelope for food, an envelope for clothing, whatever it may be. And then each month, as we get paid, we would take the cash out, decide how much cash is going in each envelope. And then once that cash runs out in that envelope for that month, our spending in that area is done for that month. Now, with things being much more digital nowadays, we can do the envelope method through our online banking. So we can set up multiple checking accounts, label them these different spending categories, and then we can transfer our funds every month into those different checking accounts, and then we can spend our money that way. The next strategy is the zero sum method. With this budgeting strategy, we are allocating every penny that we have coming in to a particular category so that there's nothing left over at the end. And there's a particular situation that the zero sum method helps with. And the situation is, let's say, so I can say I'm guilty of this too. Sometimes I'll get paid, and then I will be swiping that debit card, and next thing I know, all my money's gone and I don't have any clue where it all went. I wasn't keeping track of it. I was just kind of swiping that card as I went throughout the month. So the zero sum method, by allocating all of our earnings to particular categories that we're spending in, we know where our money is going, and we don't have that situation of, one moment realizing, where did all of my money go? The next budgeting strategy is the automatic strategy. And this is just exactly as it sounds, just automating as much as possible. And it's using bill pay, online transfers, whatever you can set up as an automatic payment or automatic transfer, set it up like that. And that's just less that we have to think about. The final strategy is the reverse budgeting strategy. And this one is prioritizing savings and debt repayment. So with this strategy, of course, we're making sure that our needs are taken care of, our bills, those important things are paid for, taken care of. But then we're deciding how much we want to put in our savings account before we start putting money towards our wants and the fun things. So it's really putting an emphasis on that savings or debt repayment piece. Now, you don't have to pick just one of these. You can use like a mixture of all of them, or if there's just like two that you like in particular, just focus on those two. But when it comes to a budgeting strategy, make it your own. Like what works for you, what works for your lifestyle, what works for your budget. So the more that we create our budget, in a way that we like and that is easy to use, we'll be more likely to stick with it. Now, there's another budgeting strategy that we want to share, and it's known as the percentile method. So, with this one, we are allocating all of our spending into three categories. So, we have our needs, our wants, and our savings. And then it assigns a percentage of our budget towards that category. So, the guideline is that 50% goes towards needs, 30% goes towards wants, and then 20% goes towards savings. And a few things about this method. So, what I really like about it is that because it's based in percentages and not dollars, then it can, fluctuate and move with us as our situation changes, as our income changes. Also, as with any budgeting method, this is based on our take home pay. So, we always want to budget with what we're actually going home with rather than our pre tax earnings. And as I mentioned, this is a guideline, that 50-30-20. So it's not set in stone. If you find that your needs actually take up 65% of your budget, then that's okay. Have your needs take up that much and then make adjustments in the other two categories. Also, that 20% towards savings, that can feel like a lot, right? That can feel like a really big chunk of our budget, especially if we're just getting started with budgeting. So if 20% feels like a little overwhelming, then just start with something. So whether it's $5 a month or 5% of our budget, whatever you feel comfortable with, just start with something on that savings piece. Just go ahead and develop that habit of contributing to your savings. And then over time, you can add more to it as you're able to and as you feel comfortable. We're going to talk about savings in a little more detail here in a moment, but just want to note that that 20% towards savings, that is, there's a lot of different buckets under that. So that's more like an umbrella that covers a lot of different areas of savings, but we'll get into that here in just a moment. Now, when it comes to our needs and our wants, that's, sometimes there can be some gray area in determining what is more of a need and what is more of a want. So, something that you can do to help make that determination of what is a need or what is a want is to keep our values in mind. What are those things that are really important to us? What are those goals that we have? And, if someone just walks up to you and says, like, hey, what are your top five values? That might not be the easiest question to answer. So it can help to take some time to like reflect on that. There's a lot of different exercises that you can find online that help you like narrow down what your top values are. So I recommend taking some time to do that and make those determinations. Because once you know truly like what those top values are, then you can base your budget around that. And you know that you're spending your money on things that are truly important to you. And as you do that, you might notice that it is a shift in your mindset. So you may start viewing certain purchases in a different light when you are asking yourself that question of, does this spending align with what is really, truly important to me? Or is the spending going to take away from those goals and those values? Another thing that we can do to help us stick to our goals is to get creative and have some fun with your online banking. So make that emotional connection to those goals that you have. You can label your different checking and savings accounts, those different goals that you have. And by doing that, it can help us stick to them a little better. So if we find ourselves making maybe an impulse purchase, something we hadn't planned on purchasing or didn't really have it in the budget for, and we have to dip into our trip to Tahiti fund to make that purchase, that might cause us to stop and think, do I really want to take away from my trip to Tahiti to buy, this pair of boots that I saw? And if that pair of boots is really truly that important to you, then absolutely, make it part of your budget. But by labeling your accounts, what your different goals are, then you can just hold yourself a little more accountable to sticking to them. All right, so let's get into that savings piece a little bit more. And I do want to mention that 20% towards savings that we saw in the percentile budgeting method, that also includes debt repayment. So I want to make sure that you know that as well. But as I said, the savings piece has different savings buckets. So there's different types of savings that we can be working towards. And the first is our periodic savings. So this type of savings is saving up for those occasional expenses that come up throughout the year. So it might be something like, having to replace the tires on our car. So we know that at some point we're going to have to get new tires, but we just don't know when that might happen. So if we go and start setting aside some money every single month to prepare for that event, then when that time comes, we already have the money set aside for it and we don't have to go into debt to cover that expense. It could also be something like maybe we have a subscription that only charges once per year. So we know every year this subscription is going to pull money from my account. So I can figure out, okay, once a year it's this amount. So how much do I need to put aside every month for the 12 months prior to that to be able to pay for that subscription? Or it could be something like our HOA dues if those come out annually or twice a year or however it is. So whatever those periodic expenses are, take a look through your budget, take a look through your spending, see, determine what some of those periodic expenses may be for you, and then decide how much each month you want to set aside in savings to be able to cover that when it comes up. The next type of savings is emergency savings, also known as the safety net savings. And this one is geared towards covering those life happens events. So sometimes life happens and life doesn't like to tell us when it's going to happen. So the more that we can go ahead and start preparing for those what if situations, this the better position that we'll be putting ourselves in. There's a few different steps to creating an emergency savings. And the first is to just get started. So that is looking at how much do I want to put towards my emergency savings every month. So back to that 20% towards savings from the 50-30-20 model, we have to decide, how much is going towards debt repayment, how much is going towards periodic savings, and how much is going towards an emergency savings. So that's the getting started piece, just making that determination. And then making it easy to access. So our emergency savings, we typically recommend not having it tied up in something like investments or a CD or something where you may have to pay a penalty to withdraw the funds. Because when an emergency happens, we want to have easy access to those funds without having to pay any penalties. So finding, a great like savings or money market account that's liquid, you can withdraw from it without paying any fees. Something that gets a decent interest rate can be a good spot for your emergency savings. Next is to calculate your goals. So typically, the recommendation for an emergency savings is to have 3 to 6 months worth of expenses set aside in your emergency savings. And y'all, that's a lot, right? That's a big chunk of money. I know when I first calculated how much 6 months worth of expenses was for me, I about fell out of my chair. I was like, well, that's a really big number. So it can be a little daunting, which is why we recommend starting out with something a little bit smaller. So a lot of folks don't have $1,000 set aside to cover an emergency. So that's a really great place to start. So starting with a goal of just $1,000, and then you can work up from there. So once you hit your goal of having 1,000 set aside, then you can look at increasing that until you get to the point of having 6 months worth of expenses set aside. Another way to look at this is to say, okay, I want to have, 2 months worth of rent or 2 months of my mortgage set aside as an initial goal. Or maybe a month's worth of food, whatever that cost is, that be your initial goal. So whatever it is for you, whatever makes sense for you, whatever is important to you, set those goals, but definitely recommend starting smaller and then building up along the way. And it just makes it a little more manageable and easy to stick to. Next up is to define an emergency. So that might look a little bit different for all of us. Ultimately, an emergency is going to be something that would have a negative impact on our finances, but that can look different for all of us. So, thinking about, okay, what would be an emergency to me, and so what do I want to save this emergency savings for? Like, what are those situations? And that can change over time. So that has happened to me before. I've thought to myself, well, here's my list of what I would use my emergency savings for, but then something else I'd never thought about came up, and I was glad I had emergency savings to cover that other event that I didn't initially think of as an emergency, but in the moment it absolutely was. And lastly is to know your unknowns. So we have known unknowns and then unknown unknowns. So our known unknowns, those are the things that we know are going to happen at some point. We just don't know when they're going to happen. So back to the example of having to get new tires for our car. We know that at some point we're going to have to do that. We just don't know when that may actually happen. So those are known unknowns, and those are the things we want to try to set money aside in our periodic savings for. Our unknown unknowns, those are the things that, we hope they don't actually ever happen, like losing a job or running into like some medical debt or anything like that. We hope they don't ever happen, but they could. That could be one of those big, life happens situations. So that's what we want to aim to use our emergency savings for. So things that we know will come up, we'll try to save for those separately, and then those other, kind of big things will. Uh, the recommendation is to save our emergency savings for those unknown unknowns. Now, our last bucket of savings we have for you is our long-term savings. So this is looking at things a little more further out down the road. So maybe saving up for a down payment for a house, to go on a big vacation, looking even further ahead into retirement. And so this type of savings is for those things that we have a little more time to plan for and to save for. But think about what those goals are, those long-term goals that you have that you want to save up for, and then just like with the other types of savings, making that determination of how much do I want to set aside each month to prepare for this, big thing down the road that I want to do. All right, so we have those different types of savings, and again, that 20% towards savings from the 50-30-20 is covers all of this, covers all these different types of savings as well as any debt repayment that we have. Now, even if we have, everything in place with our budget, we're feeling good, sometimes things can still pop up and get in the way. And we call these things budget busters. So these are things that we want to just be mindful of and watch out for so that they don't become something that throws us off track and throws us off from achieving those different goals that we have. Budget busters come in all types of varieties, but we have a couple here to share with you. And the first is our spending habits. So that can easily become a budget buster. Depending on what our spending habits look like, it might seem like a little expense here and there, but over time, those little things can really build up and become something bigger. So I'll share for myself, for example, I used to get coffee used to purchase it, out of the house while I was at work. And I didn't realize how much I was actually spending on it until I took the time to sit down with my budget. I looked through the last several months of my spending and I realized, wow, I'm spending a lot more money than I realized on buying coffee. And so then I had to ask myself, is this important? And the answer was, yes, coffee is important, but I don't always have to get it out of the house. So I started purchasing coffee, like grounds to make my own coffee at home, started saving a ton of money. And then if I want to get coffee out, I save that for a treat myself day. So looking at our spending habits can help us stay on track with our budget. There's sometimes we just don't realize how much we're spending on different things. And if you see that you are spending more than you realize in a certain area, go back to that question of like, is this important to me? If it is important to you, then make it part of your budget so that it doesn't build up into this thing that throws us off track. And if it's not important to you, then maybe we can look at making some changes and adjustments. The next one is impulse buying. So it gets us. It gets me too, right? Or we're out shopping in the store or scrolling online and we see something, we're like, oh, that looks nice. I'd like to get that. And we go ahead and purchase it. Like it's impulse buying just has this power over us. It's crazy. So some tips with this is if you are shopping online and you have the inclination to make an impulse purchase, put it in the cart and let it sit for 24 hours, right? Let it sit for 24 hours and then go back to it and see if it's something that you do still really want. And then you can look at your budget and see, if we have room for it or if it's something that we need to save up for. If we're out shopping in a store, my best piece of advice is to make a list of what you are planning on purchasing when you go into that store and just try to stick to your list as best as you can. And if there's something that you want to make impulse purchase that's not on our list, we'll try really hard to stick to that list. And then again, we can go home and make the determination of, okay, do we have room on our budget or is this something that we want to save up for? And then lastly is retail therapy. So with this one, if we're having a rough day or feeling kind of stressed out, then it can, sometimes help to go out and, buy something for ourselves to help ourselves feel better. And while doing that sometimes is, totally fine, we just want to watch out of that becoming a habit. So that can become a very expensive habit very quickly. So just something to be aware of and, just be mindful of. Another area that can, potentially become a budget buster is going to be subscription services. So subscription services can take up a really big chunk of our budget. So $219 is the average amount paid each month for subscription services, which is a lot. That's a big chunk of our budget. And a lot of us say it's easy to forget these monthly subscription charges, right? We set them up, set up the recurring charge and don't really ever think about it again. Also, there's subscriptions for everything. There's so many subscriptions out there, and it's so easy to sign up for and set up that reoccurring charge. So my recommendation is to first make a list of all of the subscriptions that you have. Take an inventory and see if you truly using everything or are there some that we can go in and cancel. You can also set yourself reminders like a couple days or a week before that recurring charge is going to happen so that at that time you can evaluate, is this something that I want to, pay another month or another year for? And not all of us are up for sharing streaming services with someone. So our recommendation for this is to only pay for the ones that you're actually using. So if we're not sharing services with someone, then let's say there's one particular streaming service that I'm watching a show on right now. So keep that one and then cancel the others. And then finish the show on that streaming service. And if there's another one you want to use, cancel the one you were watching and then sign up for the other one. But rather than paying for 7 streaming services when you're only watching a show on one of them, cancel those other ones. You can save some money in that way too. And then lastly, it's a lot of us are paying for recurring subscriptions that we're not using. I'm guilty of that too. I've absolutely been in that situation. And so what we can do is just keep those savings goals in mind. Keep those things in mind that are really important to us that we want to save up for and work towards. And by keeping those things in mind, it can help kind of cut the ties with these other subscriptions that we're not actually using. And when we do that inventory, right, like I said at the beginning, take that inventory of all of our subscriptions, we can help identify those ones that we're not actually using anymore. All right, and lastly, for today's webinar, we just want to touch on what is known as lifestyle inflation. So this is our tendency as people to increase our spending as we see our income increase. So we might see our income at this level, and then our spending is about here, but then we'll see our income go up, and then our spending goes up, and then it just like kind of keeps following each other like that. And when that happens, we can find ourselves just in this continuous cycle of just always having to make more money to keep up with our spending that we're doing. So, some things to help keep this in check and help avoid it from happening. First is to stick to our values. We determine what our values are, and if we're aligning our spending with our values, then that can help avoid the situation from happening. Also, being mindful of unnecessary, expensive purchases. So as we see our income increasing, we find ourselves making, just a abnormal, expensive purchase. Some purchases absolutely, need to happen. Those are necessary ones, but those unnecessary ones, if we recognize that happening, we can take a moment, pause, take a step back, and ask ourselves, if this is something that we truly want to spend our money on or not. But a big one with lifestyle inflation is just to practice the paying yourself first. So when we see an increase in our income, go ahead and increase that savings piece first, and then get to the fun and the want stuff. So by no means, like I'm not saying to not have fun. I'm not saying to, not enjoy life. Like absolutely treat yourself for sure. But if we go ahead and increase that savings piece first before we get into the wants and the fun stuff, then we're just, setting our future self up for a better position. All right, so just how with the budgeting strategies, there's a lot of different ones, and the most important thing is to find the one that you like the most. Same thing with budgeting tools. So there's a lot of budgeting tools and budgeting apps out there. Find the one that you like, check with your institution to see if they have one. But we have one for our INT members called Money Insight. Really, really great tool. You can bring everything into this one place, no matter like if you're where your credit cards are, where your loans are, your checking, your savings, everything can come into this one place so that you can see the big picture and you can get organized like with your spending and have different categories. And there are these super fun bubbles that change different colors as you spend in that category each month. So, really great tool to use. Highly recommend it. But again, find the one that fits your life and that you think that you will be more likely to use. All right. Well, I appreciate you all so much for joining us today for this webinar. I hope that you all have a wonderful rest of the day. Please be sure to check out our other webinars that we have, both live and recordings. And I hope to see you all soon. All right. Thanks so much.